Welcome back to another episode of Power Stage Radio. I'm your host, Karema Mutlu. And on today's show, we have Chris Berry, who is the president of House Martin Partners and is a leading commentator on the battery metal space. Welcome back to the show, Chris.
Hi, thanks for having me back.
Let's begin by talking about the current lithium markets. At the beginning of the year, we talked about the softness in the lithium price and the juniors who may be struggling. So where are we in the space today, Chris, for lithium and the related juniors? Is the lithium industry, in your view, in perhaps a better shape than it was, say, 6 to 8 months ago?
Well, if you judge that based on share price, the answer is obviously no. I think that, for a while I've been saying that, when you look at the current lithium market, or maybe the whole battery metals market overall, we're at the end of the beginning, to steal a phrase from Winston Churchill. This is a much longer cycle, sort of a structural shift around mobility and energy storage that we're much closer to the beginning of than we are the end. That said, I think one of the maybe surprises to a lot of generalist investors that are new to the battery metal space is that, look, whether or not it's lithium or cobalt or cathode, I mean, it is a sector that is subject to cycles, supply and demand and pricing. And so, that's sort of where we are. My view is, we've shifted from the end of the beginning to what I now call the long and winding road. With the investors that I'm speaking with, the number one question is, where's the bottom? When are we going to, get a pricing turn? And, to answer that question directly, I wouldn't see lithium pricing, just to use that as an example, ticking up before the end of next year, okay? And there are a number of reasons for that. I don't think we're going to crash down to $6,000 or $7,000 a ton for carbonate or hydroxide, by the way. My longer-term view is I think we settle in at about an $11,000 blended battery-grade lithium price longer term. But nevertheless, in the near term, look, the Western Australian spodumene producers have been enormously successful, quite frankly, in terms of building their projects. They're not yet fully vertically integrated, but at least building the mine and producing concentrate at or near spec. And so what that has done has taken the spodumene price from roughly $900 a ton to around $600 a ton. And I'm assuming, we'll see $500 a ton before this is over, which is going to be a challenging time for, again, those non-integrated spodumene producers in Western Australia. So, my own view is that because of conversion capacity bottlenecks, predominantly inside China, you're going to see the lithium price. And again, I'm just using it, when I say lithium price, I'm talking lithium carbonate equivalent, really range bound for the next 18 months, maybe up or down 5%, give or take. And so, sideways markets, quite frankly, aren't as exciting as ones that are all going up or going down. I do think there's one important distinction that you want to keep in mind here, and it has to do with demand. Anybody that I am speaking with along the supply chain, from OEMs to cathode manufacturers, the miners, you name it, nobody sees a let up in demand. Okay, when you start seeing things like, big battery companies like CATL start to ramp back their announcements for gigafactory or megafactory production, say from 100 gigawatt hours to 25 gigawatt hours, then I think you can start getting nervous. But you're just not seeing that. Okay, you're seeing really no chinks in the demand armor, as I like to say it. A couple more points, and then I'll stop here just with respect to the lithium market. On the pricing side, I think we're going to stay range bound partially, again, because of the amount of product in the market, but also, look, there's just not a lot of investor interest right now. Hedge funds really drove the market higher and drove it lower. And they really need volatility in the market to make money. So if I'm correct, and lithium pricing is in sort of a 5% range, that's just not interesting to the average hedge fund who makes money on the vol, both on the way up and the way down. Some of the more patient, larger pools of capital that I'm speaking with, pension funds, insurance companies, they all have a view on vehicle electrification. They're generally speaking bullish. but it's a new space and it's a new paradigm. They're out there hunting for yield, and quite frankly, they're not ready to just sort of jump into this with both feet. So again, longer term, quite bullish on lithium in particular. I think the way forward for investing is sort of more akin to stock picking, for lack of a better phrase. I think M&A is likely the name of the game for now. You're going to see consolidation across the space. It'll be more opportunistic and really be driven by the fact that there's a lack of capital investment, which is going to force a reckoning for a lot of the juniors out there as they try and figure out how to survive.
That leads me on to perhaps understanding your views on the macroeconomy. And if we are heading into a global recession of some kind, how much of an impact would this have on the battery metal space? And Chris, are there any indicators that you're watching to gauge the current sentiment within the space?
Yeah, I think those are great questions. And I do think that any kind of a global macroeconomic event, a recession or what have you, will have an effect on the battery metal space. I would think that the degree of severity of any recession, would determine how badly impacted the battery metal space is. Look, you've got a situation now, in my view, from a macroeconomic perspective, it certainly seems like we're late cycle here. I think we're in the longest economic expansion in history. Almost every day you're seeing new highs in equity indices. Some of the troubling or challenging data points really revolve around debt sloshing around in the economy. You've got a situation now where you've got anywhere from 12 to 13 trillion dollars in negative yielding sovereign debt. China's GDP numbers came out yesterday. They were sort of at the lowest point they've been in 30 years. And I'm the first to admit that, nobody believes that data on its face. But nevertheless, if you follow the trends and you look at other data points like purchasing managers index data, industrial production, it's all sort of trending downwards. And so, I do struggle at times with, the very question you're asking, which is how negatively affected could the battery metal space be from a global recession? And sometimes I look at it and say, gosh, I just think that these markets are pretty small relative to, other markets or the size of the global economy, but there will certainly be an effect. In terms of what I'm watching right now to see if there's any turn, either positively or negatively, I say this sort of tongue in cheek, but I do mean it. I think the most important chart in the battery metals space today is the U.S. 10-year government bond yield chart. Okay, and on its face, you sort of look at that and you say, well, gosh, that doesn't seem like it has anything to do with batteries or whatnot. And, look, it doesn't on its face. But that chart and that yield, which is sort of clinging to about 2% right now, is a global benchmark for risk. Okay. And all you have to do is, whether or not you go on Bloomberg or Yahoo or Google Finance or whatever and look at the chart, and you just look at the trend, and yields continue to fall. They've been falling for a long time, obviously. But you would think that if the U.S. economy or the global economy is really as healthy as unemployment data, wage data, equity indice data seem to indicate, that we would have much higher yields in the economy. Okay, the 10-year yield would be, I don't know, I'm just picking a number here, it would be 3%, 3.5%, 4%, not 2%, and arguably going lower. A 2% yield on the US 10-year tells me that there is no appetite for investor risk-taking right now, which is a challenge. And so you've got that and that sort of view on investor risk-taking, and also the trade war and that rhetoric, which I think is starting to be felt again, in Chinese data, in U.S. data, actually data all over the world. So it's a real overhang on growth. And I think we're going to continue to see some of those adverse effects ripple globally through what are integrated supply chains as the tariffs keep biting into the system.
The rare earth industry is perhaps a classic example of a fast boom and bust cycle that can make investors a lot of money if they're nimble to take advantage of the run-up. Are we setting up for perhaps another boom and bust period as we saw in 2011? Or is the trade war threat between the US and China potentially going to disrupt this market? What are your views?
Well, I certainly hope there's not a boom and bust, because again, longer term, what that does is it alienates investors. I mean, I think we can all look at the geopolitical realities of rare earths, and where they're mined, where they're produced. I'm not going to go through it because we all know the history from 2012 and how China owns the supply chain. I think a boom and a bust is unlikely. I think China is playing their cards pretty close to the vest. They have obviously, gone public, if you will, with the idea that, look, we know that we can utilize the rare earth card if we need to. I think they've sort of said, don't say we didn't warn you. But I wouldn't necessarily think they would. The Chinese are well on the way to becoming net importers of rare earths of certain types. Okay. A lot of that has to do with just demand in general and also tighter environmental restrictions. I just wouldn't see, if the Chinese are going to play this rare earth card and cut off exports and do what they did, in 2011, 2012, I really see it as a last resort. One of the other things that has happened in the last 6 or 7 years since that rare earth boom and bust is I think that end users of rare earths, whether or not it's in the automotive sector, fluid cracking catalysts, look, they're all aware of substitutes. Okay. And this isn't the sort of thing where, if tomorrow dysprosium access gets cut off or neodymium, praseodymium magnets get cut off, there's going to be an immediate switch. But I just think that the wounds of 2012, sort of led by the collapse of Molycorp, are fresh in investors and end users' minds. And I think that I'll call it the threat of substitution, the reality of substitution, is going to, longer term, I think, mitigate any kind of boom and bust in undoubtedly what is a very, very important market to various technologies around electric vehicles and wind turbines and so on and so forth. So I don't really see, a repeat of 2012 here at all. No.
But energy storage and EVs are a relatively new industry that appear to be disrupting old models. So, Chris, what authors or books have perhaps helped to guide you for opportunities such as these in these new industries? Are there any books that have helped shape your contrarian mindset within the resource space?
That is a fantastic question. Because, it's not sort of your typical supply and demand, what's going on with price sort of question that you get with a lot of these interviews. But, interestingly enough, a lot of what I have read over the last, 10 to 15 to 20 years doesn't really focus on resources per se, just more sort of macroeconomic investing. I've always been interested in kind of two major themes here, the push and pull between inflation and deflation, and which force is, for lack of a better phrase, winning in an economy. And again, the idea that probably more importantly, when you start talking about junior mining and technology, is that innovation ultimately drives growth. It's innovation that provides for a strong and vibrant middle class, which is a must for any self-sustaining society. So, that's just very briefly how I tend to look at the world. I do think that, I'm more biased towards deflation as opposed to inflation, again, in large part due to the fact that you've got this enormous debt overhang in the economy and excess capacity everywhere. Some of the books that have really shaped my thinking, look, in no particular order, there's a book called Capital Returns. It's actually a collection of essays by Marathon Asset Management. This is actually required reading for a lot of analysts on the buy side and the sell side. And what they really do here is discuss their view on the capital cycle. How money gets raised, how opportunities are perceived. And they offer case studies of, for lack of a better phrase, classic new paradigms, which fell victim to hype and overinvestment, and sort of the upside and of course the downside, and what happens in the wake of a bust, sort of the resulting carnage, setting the stage for cheap asset acquisition and continued growth and innovation, which again really drives growth going forward. In addition to that, I try and read anything by Gary Schilling. He's a well-known economist here in the United States. Again, a deflationist at heart, but his views on excess capacity in the economy and what it means for returns and how to play it have been really, I think, impactful in terms of shaping how I view the world. Let's see what else. A couple more: Manias, Panics, and Crashes by Charles Kindleberger. That's sort of an old favorite. Against the Gods by Peter Bernstein. That is basically the definitive history of risk. Very, very interesting, impactful book. And then one last thing. I know I'm going through a lot here, but there's a debate going on in the economy today about technology and about productivity. Okay, and whether or not productivity, in other words, more output per the same unit of labor, can continue to drive returns today and in the future as it has in the past. In other words, can innovation in artificial intelligence, in batteries, in IT drive the same sort of sustained growth that, for example, the United States saw between, say, the Civil War and World War II? And so the debate really centers, I guess, is being had these days between two individuals. An academic out of Northwestern University named Robert Gordon, and he wrote this absolutely fascinating but gigantic book called The Rise and Fall of American Growth, where he basically says, look, we have innovated basically as much as we possibly can, and all of these other innovations around technology aren't going to benefit society at large the same way outdoor or indoor plumbing, for example, had historically. So he's on one side of the debate. He would sort of be in the Luddite camp, I guess. And the other side is, again, another academic. This gentleman's name is Eric Brynjolfsson. He is a professor at MIT. He's written a book with a colleague called The Second Machine Age, which is actually the antithesis of the Robert Gordon argument, which is we have no idea how AI and batteries and IT, for example, are going to spread opportunity and prosperity and wealth across the global economy. And part of the issue is that a lot of the statistics and a lot of those productivity benefits aren't picked up in existing economic statistics. So, it's a debate that's sort of ongoing. I personally, I'm certainly in the Eric Brynjolfsson camp, but I don't think you can ignore the lessons of history. So probably a lot more information that you wanted there, Karim, but that's sort of what I'm looking at right now and some of the books that I've read to really help shape my view of the world.
No, some excellent suggestions there, especially Capital Returns. I would advise every investor to read that book, definitely. Okay, as we begin to wrap up, Chris, what are perhaps the most important issues that investors in the battery metal space need to be watching over, say, the next 24 months? And could you briefly give us your analysis on the development of solid-state batteries? Are they a threat to the nickel or lithium markets over the long term?
Sure. Well, to answer your first question, I think the two or three most important issues in battery metals. I mean, look, obviously, I've sort of talked it to death here during the interview, but I do think that the macro economy, in other words, the macro is going to drive the micro here. If we can continue to sort of sustain growth, I think ultimately the battery metals space will be fine. But if we do enter into some sort of a mild or God forbid, a deeper recession, you're going to want to keep an eye on, for example, again, like I mentioned before, that U.S. 10-year. If it goes to 1% or anything significantly below 2% where we are today, I think that's a really, really ominous sign for the economy overall and just kind of investment in battery metals. U.S. dollar strength, weakness. Of course, we've got an election coming up here in the United States. So just some of those macro views on the battery side. I think, look, again, I just don't see any let up in demand. And so I think you want to keep a very close eye on how the rollout of electric vehicles, I guess, is received over the next 12 to 18 to 24 months. We're about to see an actual tsunami come, not just from Chinese companies, but of course, Daimler, BMW, Ford. They're all going to be releasing their own models to ultimately compete with Tesla. So I want to see how that is handled and how investors, I guess, take up, let's say, non-Tesla EVs. I also think one of the issues you're going to want to pay very close attention to is battery quality. Look, we know all lithium isn't necessarily created equal. That's why you got different prices for different grades and so on and so forth. But battery quality, in other words, the ability to go from mine to converted material all the way into a highly specific and pure cathode, is going to be very important. And I'm just not sure if a lot of these major battery manufacturers are going to be able to produce multi gigawatt scale high purity batteries for EVs. And so that actually may end up slowing down EV uptake. It remains to be seen. But I think battery quality is something I'm going to pay a lot of attention to over the next couple of years. Around solid state, that this one's been floating out there for a long time. Solid state batteries are here. They're actually, I don't think they're commercialized yet specifically, but there's a lot known about them, a lot known about the chemistry. I don't see solid state batteries as a threat to the lithium or nickel market. I actually see it as a huge opportunity. Again, CATL, just to use them, I mentioned them before, they're actually in the process of commercializing solid state batteries, although I'm not sure if that's for the EV space yet or not. It remains to be seen. I think that, look, solid state batteries are going to be quite good for both nickel and lithium just based on the intensity in the battery. Although, to be clear, I don't see solid state battery or even NMC 811 cathode chemistry really pushing the nickel market to stratospheric heights. The battery business is and is probably going to remain a small part of overall nickel demand. So it's going to be macro growth, I think, that drives nickel prices higher more than the battery business. But look, it raises a lot of questions around the pace and the uptake of new battery technologies, which, coming back to my original question about, or your original question about what am I looking at over the next couple of years? You really can't take your eye off of battery technology. I have a Google alert set up for just this very phrase. And, every week there's a new technology. Some Russian scientist has figured out a way to spray paint graphene or something like that. And then there's excitement and some articles get written, and then you never hear about it again. And you never hear about it again is because it takes 10 or 15 years to commercialize this technology. So you got to be putting the effort in today to understanding all of this innovation around solid state batteries, because they are going to be a reality relatively soon. I would say in the next 5 to 7 years, no doubt.
Excellent. Okay, thank you very much for your time today again, Chris. I'm sure we'll speak again in the future.
Fantastic. Thank you.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?